All right, stocks didn't finish the week very well, but we did have a good week nonetheless. So the markets had a good breakout pattern on Tuesday. It held a lot of that breakout on Wednesday and Thursday, even if it gave back just a little bit of it today. Of course, you have a very, very big week next week. How likely are we to really bust out to bullish moves next week or not? So I'm going to break that down in our videos today, kind of what I expect and why based off of different charts and indicators that we typically look at. So we'll break that down to our normal routine. We'll also take a look at what sectors are really moving, different asset classes. Interesting day today from that perspective. And then our trade idea is a stock that's in the cyclical area that had its own really bearish pattern, more bearish than what the broader market did as a whole. So we'll talk about that and how it relates to the broader market move and how to trade it. So let's go ahead and get started. Today is Friday, July the 22nd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel, comment on the video down below, click that thumbs up icon, like the video, join our website at MarketScholars.com. There's that link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Also, if you're watching on our blog, check out some of these things over here on the right. Come down here, click on this heart. It opens up our Twitter account for this Market Outlook post. Click on that like button. Same thing with this thumbs up icon. Click on that like button as well. That helps get our content out to all of our followers on those social media accounts. All right, well, let's start off taking a look at the market forecast on the S&P 500, and you can see a little bit of a down day today, but we did not close at the lows, which is a good sign. You can see it didn't even bring the near-term line out of the bullish territory. So not that bad. The intermediate line is still rising. It hasn't gotten into bullish territory yet. It's still rising, though. We're still easily 3% above the 30-day moving average. So we're not going to get a red arrow anytime soon on the moving average. It's still yellow, so it's not turned green. You need it. You need the dark green shading and the green line, and obviously for more than just a day or two to really get a good intermediate run going. And like I said, even right now we're coming off of a lower intermediate low. So whereas if this is an intermediate run, ultimately turns into one like that, then obviously we have a long ways to go to get to a higher intermediate high point. In fact, as of right now, it looks like we're kind of hitting resistance at that 38% retracement level of this intermediate drop from the last intermediate high to the last intermediate low point. And that last intermediate high produced an overbought cluster, and the last intermediate low produced an oversold cluster. Pretty much we're almost right at the high and pretty much the day of the low. So at least the day of the lowest intraday low point. So now we're potentially forming a new intermediate high if that intermediate line eventually gets up into above 60 in the bullish territory. It would be an intermediate high point, and the question would be, where would that high point be relative to the last one? And that's what these Fibonacci lines are for, to kind of give us a sense of when things can change and turn around. When you get above the 78% line is when you're now more likely to get above the 100. But until you break through resistance at 38 and then 62, and you can see there's some other lines right around that 62, then you expect resistance to hold until it doesn't. That's why 4200 is a very common resistance layer right now for a lot of people, because for those reasons, for those same reasons. From the NASDAQ, you can see it was a little bit more bearish today, but it had been more bullish. So it's gotten way more than 3%. It was almost 7%, 6.75%. But you also see it got up to its 38% retracement level as a resistance and rolled over. Now we didn't close below the low of the high day, so we don't have to worry about anything like that as of right now. And when you look at the Russell 2000, you can see the same thing. It got up to the 38% retracement and actually kind of produced an engulfing pattern. It did not close below yesterday's low. But still a little bit of an engulfing pattern at resistance. And all these near-term lines, even for the NASDAQ, you can see they're all inside bullish territory. So they're dropped, and momentum is low, but the momentum's not extreme. And as long as the near-term line's still in bullish territory, there's still a decent chance that we can bounce as early as next week. Let's take a look at the weekly market forecast, since this is a Friday. And you can see the momentum line and the near-term line rally. We're still easily below the 30-day moving, or 30-week, moving average. But it's at least it's light green shading. We're still moving higher. The near-term line is in bullish territory. It's obviously still lower than the last near-term peak that we had in March, that late March rally. Actually, this would be the late May rally was the last near-term peak. There's your late March rally. So we've been progressively getting lower near-term highs, lower near-term lows, and as of right now, this high, this would be the current near-term high, is actually above. See, if you look, we go down to a near-term low, we come up to the near-term high. We go down, and then we come up. So this near-term high, you notice, was not only lower than the prior near-term high, it was lower than that near-term low point, right? And then again, you get a lower near-term low, lower near-term high. This case, because we didn't go down very much, this is a 2-week drop, the near-term high now is actually not below the prior near-term low point. So a relatively decent sign, even if the near-term line is not quite in the upper reversal zone, even like the last one was. But the momentum line at least is getting there. The momentum line is getting there, and you can see the intermediate line, like I said, is rising up above, and we're coming off of a relatively decent low below that 30-week, about as low, a little bit lower. We got 12.89% below the 30-week moving average. Here we got 15.87%, but at least we've cut that in half, by more than half, as we work our way back up to the upside. Market sentiment line is still falling, so keep that in mind. And again, if we're going to change the trend, you would like a good short-term move, whether it's the near-term line pushing higher or the momentum line. You can see if the last two dips into bearish territory on the intermediate line, the near-term line busted out up above into the reversal zone and above the 90th percentile to really bust through and break out. And you notice we kind of started to there, didn't hold, right? And then we got the oversold cluster on the weekly chart that we hadn't got since 2018. But now we're not getting the near-term line moving up above in the upper reversal zone yet, and not getting above 90. So that's why it's a little hesitation on how, and thinking that the low is set in and we are rising up now to the upside. Again, you can see the lower highs and the lower lows on the NASDAQ with the near-term line up there. And the Russell's even worse than the S&P. It is also up above slightly the prior near-term low point. But again, its near-term line can't get into good bullish territory to really signify that this trend is ending, right? And we are moving up to the upside like other times when you change the trend and you get good bullish moves. So that's what's going on there. If you look at the other weekly chart here, it is a bullish. We got all three things we look for on this chart. We got a good bullish candle. We close above the prior week's high point. It's another added benefit. The PPO is rising, and we got a green arrow, so we close up above, but not too far above, just barely. So keep that in mind that we can get back to a red arrow pretty quickly next week, and we can also get to a red candle, because you notice next week's candle will open up at the midpoint here, so 38.80-ish, and we're right now at 39.61, and that's only about an 80-point range, and you can see the full range of the week was 200 points practically, so 80 points is not that big of a move. And you can see the NASDAQ, same thing. You got this is the first time in a while. I mean, we did get a little bit of a green arrow, a good bullish candle there. I mean, like at the end of March, it looked like we had a good opportunity. So we got that here: green arrow, rising PPO, positive differential. It's the same thing. These are the three things you look for if we're going to turn up, and that looks like what we're getting right now across the board. Looking at the three green arrow charts, remember we talked about the importance of staying green throughout the week, and we have, right? All three lines. Now the MACDs are rolling over today, so let's see, if that turns into something more. You can see when the MACD rolls over, it obviously doesn't turn red until you cross below it, but obviously you can see the bullish momentum may be stalling as we head into green line there and green line here, and not necessarily a green line, or I don't have it on the Dow, and then green line there on the on IWM. So, you know, coming up towards resistance on all these major indexes with the PPO, with the MACD, excuse me, peaking and rolling over. Let's look at the two-line version of that chart. You can see that, you know, we made it up above the 50-day moving average. Really, really good. The MACD, like I said, rolling over, but it's a good sign to get at least into that area. You can see there's not very much volume above us, so if we can get through this resistance, you're going to get a pretty decent move, most likely on all the way up to this 420 area, which is, you know, I'm not the only one talking about that as a potential layer of resistance. That there's a very easy opportunity for us to get up to 420 because there's not very much volume up here. We've dropped so far that we're kind of filling in gaps, and we filled in really a good chunk of that gap right there. If you look at it on the 4-week range, you have to go back a little bit past the 4 weeks. Let's come back over here. So this gap right here we filled in, and this gap right here, which is where my cursor is the top of the gap. You notice we pretty much filled in most of that gap now. So even these gaps, you know, that you know, we haven't filled in this gap over here yet from earlier this week. It would have been Monday morning's gap. We haven't filled that one in yet, but we have filled in these bearish gaps. We filled in this bearish gap a couple of weeks ago, and now we filled in this gap this week. Now the question is whether that's, you know, that's it, whether that's all the sustainable momentum that we have now. Let's take a look at some of these other oscillators, like the RSI and the CCI. Again, being bullish gets you above 60 and above 150. We got one, just like we've done the last couple, but we haven't got both rising quite yet. You look at the NASDAQ 100, it did get above 60 and above 150, and again, right at resistance. And then you look at the Russell, and again, just barely above 50. We got above 200, but they're already, you know, falling down from resistance levels. So, you know, not quite the breakout to the upside yet. Up here, the positive got above 25 a little bit. It's already dropped down. The negative has dropped below 25, but it hasn't dropped below 20 yet, just like over here. So we're not quite there yet on these bullish breakout patterns. The Qs did. I mean, that's a great drop. In fact, you got yesterday the break above 30 on the positive DMI, just barely 30.38. And then the break below 20 down to 19. So you got the kind of bullish breakout pattern on the NASDAQ right at resistance. So, you know, hopefully that doesn't turn out to be a fake out type pattern. Looking at the Ichimoku cloud, the S&P got into the cloud yesterday. We're still in the cloud today at the bottom of the cloud. No trend going yet. So we still don't even have a bullish trend, even though we're being above the green and the blue lines now for multiple days. We can't get a good trend going because of how bearish we were prior. The Qs is also into the cloud, and it does have a trend going, and it's almost at intermediate trend strength. It has to get to 2.5 on the trend quality indicator. It has to get above 65 on the trend noise balance. So not quite there. It was still a weak trend that none of the other indexes are showing because they're still, they have been so bearish, they're not able to really get a good trend developing. Looking at the weekly chart, see the strong bearish trend on the weekly hasn't broken yet. It's still very mature on IWM. The Qs, it's still very mature on the Qs. It's below -5, it's above 80. And then SPY, you can see also still very mature. So, I mean, it's a great week. It's been a great, you know, we've had, what, 3 out of the last 5 weeks have been to the upside. And we've been filling in gaps, and that's great. But we haven't been bullish enough to at least get this to drop to 0. We don't have to start a bullish trend, but if we can get it to drop to 0, then we know at least the bearish trend is done. And as of right now, that's not necessarily the case. In fact, looking at the long-term chart here, you can see that we are above the MACD is above its moving average, but we're not quite above the 17-week moving average yet, which is what really signifies a new directional move to the upside, especially when the MACD gets above 0. And so we're not there yet. You know, over here you can see when we got that pattern. You got the green arrow on the MACD. Let's see, we're still Still slightly bear. No, you're bullish there. You got the green arrow on the MACD right there, which means the MACD crossed above its moving average, and you crossed above the 17-day, and you got a good. That was coming off of the 2018 correction low, and you got a good directional move coming out of it. Same thing over here. You got above the 17 right there with a green arrow on the MACD, and 1 week after one little bit of a bearish week, we rallied up. Off of that low point, we started a new directional move to the upside. We're not there yet on this, because if we do get there, we will be getting above these 38% retracement levels and starting to work our way up to the next layer of resistance and potentially beyond, if we are indeed just coming off of a correction low point here. Let's take a look at the Bollinger Bands, especially with the Keltner channel, so let's do that. You can see the upper band as of right now is kind of held as a resistance, because the upper band is still inside the Keltner channel. So we still have the red dots. We don't have the green dots, which are associated with a breakout out of here. So you have red dots. You have, we're still in the upper quartile, but just barely at the 80th percentile. We were actually a little bit below the 75th percentile at the lows of the day today. So we're, as you can see, just how precarious this is. I mean, it was a good bullish move the last couple of days. It's really kind of held a breakout, and today it's not surprising when you kind of get above a breakout level. It's not surprising you get an exhale. Now if we can hold here at 390 at the worst case scenario, and then continue to rise and get through this area, get through this week's highs, great. Then we're getting an intermediate run that can last 1 to 3 months. That will be, that probably means that this is the correction low, and this is our correction bounce, and we'll see if it ultimately fails at these resistance levels, at the 50 to 62% retracements, where other failed correction bounces ended. So that's something to keep an eye on. But, I think the more likely scenario is, very similar to what we have seen previously, where you kind of look like we're going to break out, and then we just bomb, and we look like we're going to break out, and then we just fake out, right? And fake outs tend to be more bearish than breakouts. And so I'm worried that this week might end up being a fake out if we get back below 390 next week. Now, it doesn't mean we're going to tank, because I don't think we're tanking anymore. We're in divergence mode or convergence mode, excuse me, on the long-term chart. So, what took us to get from here to, from this layer, which is pretty much where we're at the highs of the day, to get from the top of that gap down to the lows, it took 1, 2, 3, 4, 5 days. So we're not going to drop back down. If we do hit 362 again, we're not going to hit it by next Friday in 5 days. It's probably going to take 3 or 4 weeks to get back down to 362, because we're in convergence mode anymore. We're not in bearish divergence mode anymore, where you get strong moves to the downside. You're in bearish convergence mode, which means you get small moves to the downside, if at all, right? If we do get any moves to the downside, and you start to prepare for bigger moves to the upside once you switch to bullish divergence mode, like I showed you before. Let's take a look at the volatility index, which just has not been moving because the VVIX is really low, right? So the volatility index is still, finishing this week. This is the first week in a while that we finished below 90%. We did that in March and April too. We didn't quite just finish just a little bit below. When we got below 90%, we got below 85% too, and finished 3 weeks below 85%. So it's a good sign, but the difference is the VVIX back in March, mid-March, and then of course back in some of these other layers, the VVIX was a little bit higher, right? The VVIX back in mid-March right here, you can see the VVIX was up above at the 130. So, when we were breaking down to below 90% down here, we were getting some pretty decent moves to the downside on the VIX, because the VVIX was still pretty high. The VVIX now, as we break below 90, is not really high. It's below 85, which is traditionally pretty low for the VVIX, as you can see across the board. This is a relatively low layer, and when VVIX is low, like over here, very similar area in pre-COVID, when it got this low, in this case the volatility index was at extreme lows itself, then it's set up for a move. When the VVIX goes up, generally the VIX goes up too. And so that's the issue we have going in the next couple of weeks, which, remember, I think I showed you this in a prior market outlook video. The seasonality for not only the VVIX over the next little bit, but the seasonality for the VIX over the next little bit is bullish, right? So over the next couple of months, going through September and October, and even August for that matter, tend to be pretty bullish times for volatility. So keep that in mind as we head out of July here by the end of next week and we head into a new month, especially considering this last week in July can be pretty volatile. We have some major earnings coming up in addition to the widely anticipated Fed announcement of 75 basis points. Let's take one quick more look here at this chart. So we did get a higher high and a higher low on the S&P. We did not close above last week's high or yesterday's high. We closed well below it. So again, another sign that resistance may be holding here. Though we still do have a good bullish Arun indicator. However, the green line still way up. But you notice the red line moved up too. So that's okay. You know, that's not necessarily a bearish sign. It's when the red crosses the green that you worry about bearishness, right? About, you know, that's when we get the new lows and worry about the bearish trend. So we're not quite there at that point, and we're still got, you know, the new highs over here, and that new high will be up here for a while because we're either going to get new highs or, you know, this one's going to just slowly move over. This one's going to gradually move over here. The big round number at 400. We hope that that ends up not being a resistance, right? Big round numbers can also act as resistance. And remember, we still have this gap down here that is more, these two for that matter, that are common gaps that are more likely to fill than not. So keep that in mind too as we start to look at. You can see this week's low is going to be right there, and then this week's high is going to be up here. So if we're going to flirt with last week's low or get below it, then we're going to be filling in that gap. All right, but if we flirt with this week's high, then we have a good chance of being bullish for a while, right? For getting this intermediate line up into bullish territory and staying there for however, even if it's just for a month, like we saw over here. You know, that's an opportunity we have if we can get above this 420 layer. My expectation is more than likely we're not. More than likely we're going to end up kind of holding resistance at this spot and flirting with probably back down to 38.25 into this area by the end of the week, and potentially working our way back down into this spot. But again, with more ups and downs, so it'll be more gradual than this 5-day decline was to get us there in the first place. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, now let's move on into what's driving the price action. You can see the last 3 months, this, again, the dollar's just been so bullish over the last 3 months, way outpacing anything else, and commodities had been really bullish the early part of this month, going into mid-June before really falling off like a rock there. Let's look at just today alone and how things performed here today. So let's come up here to a 5-minute chart. So bonds, long-term bonds, were your biggest performer, and global bonds were your best performer today. Here's a risk-off move. Real estate up, gold up. The dollar was down, but it was up against equities. Really only developed market equities are the only equity asset class that came close to break even. All the others off their lows of the day, but down 1% to 2% on IWM and QQQ. Let's zoom out to how they performed for the week. And you can see for most of the week, they were actually pretty bullish. So pretty much it was just by the end of the week, they're still up 2.5% to 4%. IWM, QQQ up the most. So what goes up the most comes down the most. That's not surprising. Unfortunately, the dollar being down this week, but it was really commodities that came down, which goes to show that maybe we're not as bullish here because commodities were following along with the U.S. equity market. Started the week really strong, but then started the week up almost 3% at the very beginning of the week on Monday, but then finished down more than 0.5% for the week by the end of the week. So kind of goes to show that maybe we're not as bullish on equities as we were. I mean, they still held their ground while equities were rallying, but then since that peak, they dropped sharply. So let's take a look at some of these different charts here, especially the dollar, as bearish as it was this week. And let's look at it relative to the euro. We had a really good discussion in our portfolio management class yesterday on the dollar, and remember it's not like the dollar appears here. Let's go to UUP. The dollar appears to have been pretty bullish pretty much since here, let's go to a daily chart. Yeah, let's go out a few years so we can get to this low point. So really the dollar took off right there. A little bit of a move up higher there, but that breakout on 6/16, the dollar's been pretty bullish ever since. But if you take a look at it, it's not really the dollar that's been as bullish. When you look at this chart and we go out to 6/16 of last year all the way into now, when you look at this chart, yes, the dollar is up against, you know, the Mexican peso, Canadian dollar. Those are the two biggest trading partners. You have Swiss franc. You know, it's pretty much up against everybody, but it's 15% up against the euro and it's 23% up against the yen. These two currencies make up 70% by themselves of UUP. The other four currencies in the index make up the other 30%. So, and really it's the euro by itself that makes up over 50. So it's really how it's the weakness in the euro, and if you look at the euro versus the pound, the euro versus the Austrian kiwi, the euro versus the franc. I mean, the euro versus the franc, there shouldn't be that big of a gap. Those two are very correlated with each other. The euro is essentially the Deutsche Mark, and those are it's very correlated with the franc, but not over this past period. It's been a significant weakness in the euro, and the same thing with the yen. The yen is pretty correlated with the franc too, in that they are both safety trades, right? You can see they were pretty much going hand in hand here until right about this area, until right about March the 4th. That right there, the yen was a little down against the franc, but not much. But from that period, the yen just dropped like a rock, and the franc stayed bullish, as you would expect it would be during a risk-off move, during a correction, right? Pretty much since the beginning of this year, since the beginning of the correction that started on the 4th from a U.S. equity standpoint, the yen's down 18%. That is not common. To show you how things performed here, let me get to where the in 18 here. So we got to let's go out to 2018. So it really started, the 2018 correction started in October the 4th and ended December the 24th. So this is what's going on now. This is the last normal correction we had, not including COVID, but the last normal correction we had was October the 4th, 2018 to the low point of December the 24th of 2018. Right, look how the yen performed, right? And the euro, you know, and the dollar was up against the Mexican peso and the Canadian dollar, because the dollar is also a safety trade. So, you know, that's how the yen performs during a correction. That's not been the case right now. It's been the exact opposite. And you remember, the yen makes up, you know, about 17% of the dollar index, which again, combined with the euro, ends up being about 70% combined, just from two currencies. And the fact again, oops, this needs to be 22. The fact again that they are down so much, that's what's really pushed the dollar higher, is the dollar index higher, is that these two currencies, especially the yen, which traditionally should be up here, outpacing all these currencies during a normal correction, it not only did not outperform, but it's actually way underperformed everything during this correction. And the euro, which doesn't, you know, again, kind of matches up with the franc, has been really moving in the opposite direction. Like, it's really had a pretty wide gap against the franc over a good chunk of time here. So you get the sense that a lot of this strength here in the dollar, imagine if the euro and the yen weren't weak, right? I mean, you look at commodity prices right now, and you see how bullish they've been, and they're starting. You know, crude oil is giving a little bit of a pullback here. We moved to the 200-day moving average after being well up above. So we've started a little bit of a pullback. We're down to the 50-week moving average. So we're down to the 200-day moving average on commodities. I think we'll probably end up holding some support at this 50% retracement and bounce up. But we did get up to about $130 when we went parabolic, and then we retraced. Took a little bit longer, but we got up to 122 again. Took a lot longer this time than just 3 or 4 days. This next go around took a few months to get there again. But you know, imagine if the euro and the yen weren't so weak. Because if they weren't so weak, that means the dollar's not so bullish. And if the dollar's not so bullish, and the dollar's actually kind of just normal, if not bearish, then, which is what happens usually when commodities rise, then this 200, like we probably would have approached $200 on crude oil, well up above, you know, the price that we got to in 2008 when we were at 2008 when we got to $150 a barrel. So and we got to 130 with an extremely strong dollar. I don't know if we have mid 2008. Here's mid 2008. You can see where the dollar index was then in mid 2008 when we got to 150. Here's where the dollar's at now, at $29 instead of at $22. So again, if we were back down to $22 right now versus 29, then there's a good chance that commodities would have blown through the roof, blown through 150. And imagine what the CPI would have been then. And imagine what this inflation would be if the dollar weren't strong, right? The dollar strong, and being strong helps make its goods a lot more expensive for foreign investors, and kind of brings that demand down a little bit and makes our inflation levels not as high as it probably would be. Usually inflation level, like mid 2008 when inflation peaked last time, if I were to go over here to this chart, over here, and we go to the inflation chart, you can see the last time we hit, you know, 5.5% on inflation year over year, or close to it, was July, August of 2008. Well, when we look at the dollar index in July, August of 2008, we were at 22, right here, July 28, we were at 22. And we started to rally there, but we were at 22, and right now we're at even higher than 5.5% year-over-year inflation, and we're at 29. Imagine what that inflation level would be if the dollar were down here. So again, why is the dollar as bullish as it is because of where the euro has been, and because the euro has been so weak, it's pushed the dollar up, and it's really going to have, as we saw, as I talked to you about in the other videos. You know, this produced QE1. This dollar rally produced QE1. This dollar rally produced QE2. This dollar rally produced QE3. This dollar rally started a global slowdown that we didn't start. We only raised rates once in 15, and then again in 2016. Like, the Fed was still, like, they weren't dropping their balance sheet. They didn't start to drop their balance sheet until 2018, and by the end of that year, they had ended rate hikes. They had ended. They had ended their quantitative tightening by the end of that year, and then 2000, because of, again, the dollar was rising, and then by COVID, by the time we got back down to these levels, we had the biggest combination of fiscal and monetary combination we've ever seen in response to COVID that helped push the euro up or the dollar down. Now the dollar is higher than any of these other levels, and you know, last time we were at this level, we were coming out of, we were in a significant bear market with, you know, as much you know, the overnight interest rate was at 1% then. That was very, very low for them. So now we are at very similar levels in the dollar, and that's got the potential to keep things not so good. From a broad macroeconomic perspective, it's not good to have the dollar this strong. As we've seen, the Fed's usually stepped in, but the Fed's not stepping in. The odds for rate hikes have dropped a little bit, but obviously we're still going to get 75 basis point hike here. We're at 80% odds now, with 20% for 100 basis points. Very unlikely. But you have 75 or 80% that we'll get to 250 at this one, and then you're at 100% odds that you'll get a 50 basis point hike in September, and you're about at a 50-50 shot that will get another 75 in September. But you're at 100% odds of getting 50 basis points in September, and then 100% odds of getting 25 in November, and then and 78% odds of getting another 25 in December. And then that's it, right? Because then once you get to 350, you can see what February and December kind of look exactly the same. So which means that February you're pretty much going to be done. Like by the end of the year, we're pretty much going to be done. So the Fed's not only not quantitative, not doing rate cuts, they're not dropping. We don't have very, very low rates. Not only because usually when we get a yield curve inversion here, usually when the yield curve inverts like it has just now, let's go to a daily chart on this. Okay, here we go. The yield curve. You can see the 2-year yield has gotten up as high as it did in late 2018, 2019 when the Fed was done raising interest rates. Look at the 6-month yield. The 6-month yield, which again is going to be a lot closer to where the Fed is, got all the way to the 6-month yield got all the way up to 2.5. It's up to 3% now. It only got to 2.5% then, so it's actually higher now than it was then too. And of course, the 3-month, you can see the 3-month here is about nearly the same level that we got to back then. And you can see the longer term, the 30-year is actually lower than it was at the end of 2018. And then our 10-year, where's that? Oh, there's the 10-year. The 10-year is the one in black here. Is actually a little bit lower than we were in 2018 too. It goes all the way back here. But you can see the 2 and the 10. The 2-year would be the purple one. The 2-year is actually above the 10. The 2-year is way up above where we were at the end of 2018 during the last rate hike cycle. And you can see the yield curve inverted down to 0.2%. Kind of give you an idea of where that fits compared to other times that the yield curve has been inverted. Let me zoom out here. So there, this is going back 20 years, right? 20 years here. This is about as inverted as we got, right? To be 20 basis points is a pretty high level for inversion relative to where we were there. Now, if I were to, let me see if it will let me go out a little bit further. So let's see if we can go out to 1980. Keep it on the daily chart. So here we go. So we can go back to, there's the last one. Here's the inversion in 2000. We actually got down to about a 50 basis point inversion. Again, with the interest rates up at 6%, 6.5%. Eventually, the 2-year topped out near 7% by May, after the NASDAQ peaked in March of 2000. So you can kind of see that, and eventually by the end of the year, by the time we got back up above zero, we were in our correction mode, right? So, and then over here you can see 20 basis points in 89 and 90 was about the same level. We got a little bit lower down to almost 50 basis points. For the most part, 20 basis points was the limit to that rate hike cycle. And then you can see we had a really deep inversion in the early 80s. It actually only lets me go to 1981. But that kind of gives you an idea. I mean, we are like, it kind of gives you a sense that this is a pretty decently low level for inversion, and we've been here at this level of inversion for, quite a few days. If I were to refresh the page, it's been quite a few days now, pretty much since the 12th. So almost going on a couple of weeks, we've been inverted here at these levels. We went from 711 down to, on 712, down to 20 basis points, 24 basis points on that day, but we've been around 20 basis points ever since. So it kind of gives you a sense of, we're pretty low, and the Fed's not apparently done, as you can see from the broader market still waiting, and you can see we are inverted at the the 2-year sitting at 3%. So the market's kind of expecting that we will get up to at 2.5 or 2 3/4, 300 basis points by the time all is said and done. And of course, if we get our 75 this go around, we'll be at 250, and if we get another 50 basis points, we'll be at 300 by the next meeting. And right now, the bond market is saying that's probably where we're going to stop, where we're going to end, and that would be a 75 and a 50, and then done at that point. And again, traditionally, when the yield curve gets back above zero is usually when the corrections start. And remember, we have already been in correction mode when you look at this on a weekly chart. We've already been in correction mode, and we might not even be done with this correction. We might not be to the point now. We are, like I said, in convergence mode, so more than likely any declines we get to retest these lows or eventually get to the 200 week won't be so, like, it won't be capitulation, right? It'll just be kind of more, this was the capitulation move, where we got so low down there. I don't know if the MACD will get to a lower low point than that, but which means we'll just kind of get gradual ups and down moves, but it won't be like straight down over however long it takes for this correction to end. Otherwise, if we can get back above the 17-week moving average and get back above these Fibonacci resistance levels around 400 to 405, then there's a good chance that we can really get going again. Like these other corrections, that we will not go into a bear market and that we will just bounce up to new highs by the end of the year, if not by the beginning of next year. All right, now let's take it. I think that's a lower probability scenario, but it's obviously it is the higher probability scenario based off of what's happened since 2007. Since late 2007, 2008, we've had 6 corrections. 5 of them have bounced up to new highs and within months. The one in 2008 obviously was our bear market, but since then we've had 5 in a row that bounced up to new highs. So the odds are, that will be the same thing here. I don't think that will be the case, but the odds are it will, right? And we'll see if that ends up happening or not. We talked today in our technical analysis class where the correction bounce would fail if we are gonna turn into a bear market, where the next peak will be relative to these highs, and where we can go from there. Let's go to and what we would do with our portfolios if we did fail at those levels. Now let's take a look at the sectors and how they performed here today. So let's look at this risk off day that we had into a 5-minute chart, and you can see these 3, which have been the most bearish throughout most of the week, rallied, and you can see that, not surprising, with Snap and Facebook down as much as they are today, the XLC was down 3.5%. So when I zoom out to the beginning of the week, XLC was one of the top performing sectors all the way up until Wednesday's close. XLC was right there with XLY, and energy was, but from that day, the XLC is now only up 1%. Everything else, like discretionary, is still pretty good, off of its highs, but still pretty good. Return almost 7% for the whole week. Technology was still up almost 4% for the week, even if it was off of its highs. Materials, industrials, financials, real energy, they're all doing pretty well too. So very bullish week. And these 3 sectors, which had been the most bearish going into today, obviously they were the most bullish today. All right, that's not surprising. But again, are these areas bullish enough to signify a new bullish trend, right? Are we getting dark green shading and green lines? Well, right now XLY is the only one, right? It had the 7% return this week. It's the only one that's got dark green shading and a green line right now. Nothing else. There are some that have dark green shading and yellow lines. There's some that's light green shading still and yellow lines, and we still have dark pink shading in utilities, and we still have a red line in energy. So we're not quite there, joining XLY across multiple sectors to the point where we could say, good, here we go, right? This is good. We haven't seen this in a while, and this is good. All right, so for our trade idea of the day, let's take a look at FCX. Look at that big engulfing pattern that FCX had. A little bit of a hanging man pattern the day before, coming off of earnings, and then gapping up today and this engulfing almost the whole entire range, obviously easily the body of the last couple of days of trading coming off of this earnings. Obviously the near-term line did go up to a higher high, even if price did not itself get up to a higher high, at least a higher closing high than the last near-term peak. And you can see we're already still 9.5% below the moving average. We still got dark pink shading and a red line, and the expectation is we'll probably continue working our way down in that direction. If you look at the 3 green arrow charts, and we never did get the green shading, and now the MACD is already rolling back over again, like pretty much everything else is in the market here. When you look at where we are relative to the moving averages, we were trying to get above the 7. We haven't been above the 8 for a long time. We got above the 8. We hadn't been above the 17 for a long time, and that didn't lie. And look at the strong momentum to get us up to the 17, stronger than any momentum in the past year, and we're already starting to lose it without, again, we're already back down below the 8-day with just losing the momentum, right? So, again, we are in convergence mode because the MACD is above its moving average, and we're not above this. We're not above the 17. So don't expect a big sharp decline like these until the MACD gets back, until we get a red arrow again on the MACD, and that's when the bearishness will really pick up to the downside, if it does. More than likely, we'll probably just come down towards these lows, towards 25 again, at a more gradual pace. You can see some of these other oscillators. Oops, not X, FCX. We didn't even get above the midpoint, and we didn't get above positive 100, at least yet, on the RSI and the CCI. The DMI, the positive appears to be hitting some resistance around 25. The negative is still above 30. So that, we're still pretty bearish from that perspective. Looking at the Bollinger Bands with the Keltner channels, you can see we got up to the midpoint of the Bollinger Bandwidth, but that was it. And the bands are still outside of the Keltner channels, which means we're still in green, which tends to get the trending moves, even if the move was kind of up and then down. We never did turn around. If you look at the whole moving average for FCX, we did get the bearish candles, we did get the green hole, we got the parabolic SAR to move around, but you notice last couple of days they haven't been bullish candles. We've been closing below. Like yesterday we had a lower close. Today we actually did have a higher close, but easily long upper shadow and easily below the last couple of days of highs. And again, where we are relative to the 200-day moving average, where the MACD is already rolling down here. So, there's some opportunity, at least in the short term. And it doesn't have to be a big move to the downside, because I don't think there will be a big move to the downside. Here's your, let's go for a couple years and pull up FCX here. So there's your, big move. There's still a lack of volume here because we moved up so far so fast in that November 20 to March 21 time frame. There's still a wide gap in volume to the downside. Obviously, the issue is, if you look at where we're at here on these long-term moving averages, just like the market, you got about to 2280 as a potential support level where the 200-day moving average is, as well as the 62% retracement. And you can also see too that from a long-term perspective, we're actually still in a bearish divergence mode. So the MACD is still way below its moving average, and we are way below the 17 days. So, we're still more bearish than we are bullish, even if we are approaching support. So what we decided to do then for our trade was to come over to the call side and do a bear call spread. Now we're done with the earnings. Sell the mid 30 deltas, buy 2 strikes away. That gets us to a regular position size, a pretty decent normal return, and then that break even. If we place that break even on the chart, you'll notice here that it's right above today's high. So if we were to pretty much nullify this engulfing pattern and start to work back up above these moving averages, we don't want to be in it anyway. We're more than willing to take a $343 loss at that point, because that's what we're trying to make. Otherwise, if we hold that area, and here's what it looks like on the intraday chart right here. So if we hold today's high for our resistance, and we get back into this area down here, then we'll more easily make the maximum gain. If not, if we can, in the next week, if we can get half of the maximum gain, we'll take it, right, in the next week before we get to the 20-day mark, because then we can free up that $1,000 of risk to try to make a full maximum gain somewhere else instead of waiting to get the other half of the maximum gain here. Alright, well that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook. Join our website at marketscholars.com for free. Have a great rest of your weekend, everybody. And we'll see you all next time.